Warm welcome to all of you. This is AKS Learning from Smart VRC, and today's topic is very relevant to the current scenario in the market. Why our portfolio? When I say our portfolio, that means mainly retail investors' portfolio is falling against the stable market indices. So the duration, I hope it would be about 40 to 50 minutes and will be followed by question and answer session. So the webinar contents has been organized under the following heads, like the underperforming portfolio, what to hold and what to sell, when the portfolio will turn around. Yes, that is very important. And what to do at this juncture, expectations from the budget, a lot of expectations as usual from investors, to be followed by question and answer session. So on 7th of January, I had a physical webinar in Bangalore on 7th January, and there were very interesting participants. There I met Mr. Deepak Agarwal. He is a young chap, and about 5 years back, he attended my workshop as well as seminar in Pune, and he's from Bangalore. Then Mr. Srikanth, he gave a warm welcome, and we had a nice time. Then we met my subscriber, who is my subscriber from the year 2003. So Mr. Madhukar, and that was a very warm gesture and nice interaction with him. He had a lot of things to tell me. Also, he was a bit critical about a couple of stocks we have advised, and he was accompanied with his son, young son. Then I met the ever youngest participant who attended my seminar or workshop, Mr. Arush. He is only 13 years old. He came along with his dad, and he had a good knowledge of stocks. And last but not the least, Madam Shakuntala Wadhwani. She is from Mumbai, and she is, I believe, 70 plus, and she had a lot of interest. There were not many other people. I cannot name all of them. Nevertheless, it was a very good meeting, and it lasted for about 3 hours, the longest ever. Thank you once again for all the Bangalore participants. And this was Mr. Srikanth. He's the author of 2 books. Subsequently, on the next day, there was a seminar in Chennai. And once again, very enthusiastic participants. Mr. Mohandas, he came all the way from Erode to attend the seminar. Mr. Murugan, he is associated with me, and he has recommended my services to many investors in UAE. And then Mr. Jitendra, I believe he is the person among the youngest participants who has attended the maximum webinars till date. Also, he is present in today's webinar. Also, there was a gentleman who had experience of more than 40 years in stock market, and he also shared his experiences, his insights. And last but not the least, I'm thankful to Mr. Padam Mehta. He was not there, but made a lot of efforts to make more and more participants attend this webinar, seminar. Thank you once again to all of you. Now I am going to Ahmedabad on 26th of January. Topic is same, but contents would be same in the sense, same what is it has been in Bangalore and Chennai. Kiss and win in stock. Kiss means keep it short and simple. Yes, it is really very simple to make tons of money from stock market, but we, the retail investors, make it complex. And I can say so because, rather I should say I am qualified to say so, because I had experience of more than 32 years, 33 years in stock market. So I'm going to share with you the insights for the market, the portfolio management, the stock picking, and controlling emotions, the most difficult one and the most rewarding one. It's a great opportunity for amateurs as well as the pros. And the venue is Hotel Silver Heights, near Passport Office. Time would be 10 a.m. to 1 p.m. Those who are interested can scan this code for the registration. So, starting today's presentation, first is the underperforming portfolio. So starting with a poll, during the last 1 year, your portfolio returns are, these are the options, positive, loss up to 10%, loss from 10 to 20%, and loss more than 20%. So I request all of you to participate. I hope you are able to see onto your screen the options. I repeat once again, during the last 1 year, your portfolio returns were positive, loss up to 10%, loss up to means loss from 10 to 20%, and loss more than 20%. I request all of you to participate. This data we are not going to share with anybody, and this will remain with us only. And in fact, we also don't recognize that who voted for what. What matters is what the general retail investors think, what the general investors are experiencing in the market. So total 68% participants have participated. I will close this voting in another 2 seconds. Thank you very much. 80% participants have shared their views, not views, their actual performance of the portfolio. So maximum is 53%, loss up to 10%. There are 27% participants who have seen positive returns. That is excellent. And there is a segment of about 18% who have made a loss of 10 to 20%. And there are 2% investors who have lost more than 20%. Thank you once again. So let's have a look at stock indices. This is the BSE sensitive index during last 1 year, and it has given positive returns of 2.68%. There were many ups and downs, went down or two, even 52,000, below 52,000, then again shoot up and crossed for maybe for a moment 63,000 also, and now presently at 60,000 with a net gain of 0.68%. So those who have invested in index ETF, Sensex ETF, or even Nifty ETF, they also there's almost the same kind of returns. They were positive returns. So here is a comparison between BSE Sensex, that is the blue chart, with the yellow one. Yellow is BSE mid cap, and at the end of the year, I mean to say during the last 1 year, BSE Sensex, as we have seen, 2.68 positive returns, and mid cap is almost 0.0. It started and ended almost on the same level. So there is hardly any gain, 0.21%. Now we have added the small cap also. Small cap is in a green color, as you can see on your screen. Small cap has underperformed by 4.46%. So it is very natural, because the retail investors are mostly invested in small cap, and that is why they have their portfolio had given negative returns, maybe something more than 4.46 negative returns or something less than 4.46% returns, until someone has made a grave mistake of adding or wrong stocks. So this is last one is the NSE Nifty. There is the orange color. As you can see, orange and blue almost move in sync, and the reason is not far to seek, because they are both broad-based indices. Despite the difference in the number of stocks in BSE Sensex, which has got stocks, and NSE Nifty has got 50 stocks. But because of the proper diversification, both move in sync, and there is hardly any difference in their movement. Even on day-to-day basis, you will find that more than 98% of the time they move in sync. So one of the prime reasons for portfolio underperformance is the improper weightage allocation. Maybe if you have got higher number of small caps, then your portfolio underperform with respect to the market. If you have a high proportion of Sensex stocks, it is quite possible that you got positive returns. Second is the sector-wise weightage. So the first reason was regarding the market cap weightage allocation. Second is the sector-wise. Had you invested more in healthcare, then healthcare index was down by 4%. Had you invested more in IT stocks, then IT index is down by 15%. So that makes the difference. If you have kept high proportion, high allocation for the information technology sector in your portfolio, then there is a good probability that your portfolio is down more than 5%. That was the first that we completed, the first reason for the portfolio underperformance, because of the weightage allocation with respect to the market, with respect to the sector. Second is the market regains sanity. When I say sanity means, yes, the end of 2021, lot many stocks they gained handsomely despite poor fundamentals. So market becomes a kind of insane. And anything in stock market cannot go permanently for long. So sanity has to come back, and not only in terms of the financial performance of the existing companies, existing listed companies, but also the companies which tap IPO market with poor financial fundamentals. They also suffered a lot. We all know the kind of loss even the IPO investors have made. And a surprise element is the potential multi-bagger stocks. Can portfolio underperform because of the potential multi-bagger stocks in your portfolio? Yes, it's very much possible, and it should be. If you have more number of potential multi-bagger stocks, then your portfolio is bound to be very, very volatile. The market is stable for long times, or if the market falls, then your portfolio is going to decline much faster. Yes, I know what I'm saying. Because of the potential multi-bagger stocks, your potential portfolio is bound to underperform. Let me tell you why. So here is an investor. When the markets are under normal level, they look for what is the forthcoming results. We can project about the forthcoming financial results. As the market continues to move up, so most of the next financial results are already discounted. Investors look for 2 years hence what would be the results. And since we are looking for potential multi-bagger, there is bound to be a great increase on year-on-year basis regarding the profitability, regarding the earnings per share. So as the momentum picks up further, we look for further 3 years hence. So an investor is looking for the performance, the financial performance for the company under consideration for 3 years hence, maybe 4 years hence. So his eyes are here, right? But when the market falls down, the general behavior of the investors is look for what happened last year. So what happened last year for a potential multi-bagger stock? Maybe it reported an EPS of 10, but these investors invested in a stock when he was looking for the EPS of 20 for FY26. That is why the stock which he purchased looked attractive, but it fell down because of the market sentiments, because the market is not looking for the recent performance. And in fact, The fundamentals of that stock may be intact. So it is a good opportunity for this investor to increase his holding. But now, I'm very sure you must have realized why even the potential multi-baggers can contribute to the underperformance of your portfolio. Now, you can very well say that this is applicable even to the companies like Hindustan Unilever or Reliance. Why not? Why only for potential multi-baggers? Yes, it is applicable. But what happens is, for a company like Hindustan Unilever, whose earnings per share increases at the rate of maybe about 10 or 12%, the growth is not that steep. So what an investor has discounted is not that high. Earnings per share is not that high compared to the recent earnings per share. That is why this slope is almost flat, and this is almost making a 35-40 degree angle horizontal. That is the difference. And then comes, last but not the least, the stock falls under its own weight. What does it mean? Whenever the markets are stable, suppose the markets are rising. So what happens? At any point of time, there is a small percentage of investors who are in need of money and they sell. Now try to appreciate this fact. Investing is not a need, but selling is a need. So when an investor is in need of money, will definitely sell. But since the market is stable, not many new investors are coming, and not even the existing investors are not willing to put in extra money. So the share price steadily, of course, steadily. And this happens steadily over a period of time. It falls under its own weight. And this has happened especially for retail investors, because a lot of retail investors made a loss in IPO stocks, and to compensate for those loss, they have sold not only those stocks, but also some profit-making stocks from their portfolio. And that is how the stocks have fallen. And this is mainly from the retail investors' perspective. That is why the small cap and mid cap has underperformed with respect to the large cap, like Sensex. So this was all about the underperforming portfolio. Next is what to hold and what to sell. I mean to say what sectors one should hold and what sectors one should have a limited exposure and what sectors one can sell. This is just an opinion. This is not an advice. So before coming back to that topic, let's have a small look at what we do at Smart VERC. We help investors create wealth from stocks smart. So this is SVP, Smart Billionaire Picks. Most of you know very well what is SVP. This was started with 1 lakh on 30th of May 2001, with changes permitted only on Wednesday before 11 a.m. That 1 lakh has turned to 1.36 crores as on date. That gives compound returns of close to 25%. When compared to BSE Sensex, the same 1 lakh could have got converted into about 17 lakhs, and that gives compound returns of about 14 or 15%. So we have outperformed BSE Sensex by way big margin, and you can see the margin is keeping on increasing. Yeah, that is why we call it the smart performance. And if it continues to rise at this level, then it should cross 100 crores in another 18 to 19 years. And that is how 100 crores means 1 billion. This is a complimentary for all the subscribers of Smart Gains. So here are our advisory products, 3 products: Smart Gains, Smart Multibaggers, and Smart SIP. What we were discussing about the Smart Billionaire Picks on the previous page is a part of the Smart Gains. Target compound returns here are 25 to 30%. Risk is medium. Holding period 3 to 24 months in Smart Gains. Often it is 9 months to 15 months. Yes, we do provide sell advice. In fact, we provide sell advice in all the advisory products. All the publication works in a closed loop. All the publication products work in a closed loop fashion. We also provide allocation advice. I mean to say how much one should invest in that particular stock in terms of the weightage of your total portfolio. Yes, we do provide research advice for all the products. Then on philosophy, in Smart Gains and Multibagger as well as Smart SIP, is a common philosophy of bottoms up. Market focus, here it is all caps, and Smart SIP focus is on large caps. Advice time, all advice during market hours. Advice frequency, as I said, this is on Wednesday. Yes, once you subscribe to any of our product, you get fast access to the advices we have made, and subscription price is 6,000 plus GST. So coming to the next product is Smart Multibagger. Here the compound returns are 30 to 40%. Risk is low to medium because it is a long-term investment horizon. This is the long-term investment advice. So risk is low to medium. Holding period here varies from 2 to 5 years in Smart Multibagger, and rest of the things are almost common. And advice frequency, yes, this varies. In a year, we provide about 12 to 15 advices. So once in every 25 days, you can expect a Smart Multibagger stock. 1 year subscription price is 8,500 plus 18% GST. And the last one is Smart SIP. On the 5th of every month, we advise one stock, and compound returns are 20 to 22%. Risk is low because it is the product end date is perpetual, and holding period is very long. And the subscription price for 1 year is 4,000 rupees plus GST. This was all about our advisory products. And this is the medium through which we provide the advice, not only advice, but we also share our wisdom, our knowledge, website, mobile app, webinar, seminar, workshops, social media, and television. The present webinar, what you are watching, if you want to watch any previous webinar, because we have got 138 webinars. This is the 139th webinar today running. If you have an interest, you can go to this page on our website, smartverc.com, and under the Smart Academy, you will find a link, Smart Insights. Here, all the webinars recordings are available. And even you can select the category also from here if you want to know about the stocks, if you have interest about the market, etc. Can help you to become a smart investor, whether you are a new investor or even for an old investor who are not able to generate more than market returns. So apart from stock advisory, we have Smart Insights Pro. This is a set of small videos of about 15 to 20 minutes. And there is a set of about 15 to 20 videos also in each of these 4 categories, like financial freedom, equity research, portfolio management, and controlling emotions. Also, I'm an author of the book, Way to Billionaire. This book can be purchased from our website, that is smartverc.com. Also, we have got freedom calculators, investment calculators, as well as retirement calculators. You can use them to find out how much money you need at the time of retirement and how to achieve that target. This is our website, smartverc.com. How we are different. We have got a cumulative experience of 73 years. We have a very small team. And we have the ability to find the worth of the stock with good accuracy. That is the key thing required. This gives you a lot of confidence, a lot of control on your emotions, because you know the worth of the stock. That is very, very important. Otherwise, whatever you are doing in dark. So in that sense, we are truly qualified, not only in terms of the qualification, academic qualifications, but also in terms of the successful experience. All of our advice is closed loop. Yes, this we have already covered. So this was all our firm, Smart VRC. Coming back, what to hold and what to sell. So first is automobiles, two-wheeler. It would be better it would be wise to stay away from this segment for the moment because the growth is not that high as the levels during the pre-COVID period. Coming to the automobile four-wheelers, yes, four-wheelers are doing good, and especially the commercial vehicle as well as the passenger cars. But often I found that more returns are generated from the auto ancillaries than from the auto OEMs. In auto ancillaries also, there are two categories, one serving to the domestic market and one serving to the export market. For the time being, means from the medium-term perspective, you can focus on the domestic auto ancillaries. And if you are investing for long-term, maybe if you are ready to invest for 3 years or more than 3 years, then definitely you can invest in auto ancillaries which are export dependent. Yes, their performance will not be good for maybe for the next couple of quarters. Definitely 3 years hence, 4 years hence, automobile sector will once again be booming, and then you will get the multi-baggers in your hand. Metals, for the time being, avoid. Recently, GSW has declared its results, far from satisfactory. Moreover, there is a slowdown worldwide, so there is hardly any chance of big demand for the metals. FMCG, yeah, it is a neutral. I don't find many stocks which are worthy of investment. I mean to say, which are attractive, available at attractive value, hardly any. Chemicals, yeah, export-oriented chemicals may suffer even for the next couple of quarters because they are dependent on exports. Pharma, it is better to keep away from this sector because there is a very intense pricing pressure in the US market, and that pricing pressure is continuing. IT, in the medium term, no. For the long term, yes. Technology is a better proposition compared to the IT at present juncture. Defense, yes, this is the sector which is opening up, and there are companies in a very niche segment. These are small, and a couple of them are even mid cap, but they offer tremendous potential to grow in the coming 2 years, 3 years, or maybe who knows for 10 years. It depends how much the government opens this sector. Same holds good for space. Yes, you may be surprised to know that there are some really good companies engaged in precision engineering, and they are also there are companies from electronics, and they are contributing to space related projects. And now with the opening of the sector, they themselves are planning to launch their own satellite. Yes, you heard correctly. Cement is a neutral. Recently, Ultratech has declared its results, and there is nothing much to speak about. Infrastructure, in general, yes, it's a good opportunity, especially in the construction segment. Textile, domestic, yes, but textile exports, no. Same as we said for the chemicals, as we said for the auto ancillaries. Real estate, yes, real estate is doing pretty well. And instead of real estate, I would prefer to go for the companies which are indirectly dependent on real estate, like the paints, decor companies. And then, this is not the last but least, this is the banking. Banking sector is doing exceptionally well. And there are two reasons. It is not only the growth in the economy because of the growth of the economy, but also because of the reduced NPS. And NBFC, yes, their performance will be impacted because in the rising interest rate scenario, it is the banking sector which gains the most. NBFC lacks. So this was all about the what to hold and what to sell. The next is when the portfolio will turn around. So happy days back again when everybody is waiting for that. So one reason could be the improvement in stock sentiments, in stock market sentiments. When I say the improvement in market sentiments, that reason can be any. Maybe if there is a sharp decline in US inflation rate, or maybe who knows, tomorrow Russia and Ukraine decide not to continue the war, who knows. So it is the market sentiment which can bring you the happy days back again. And second is the improvement in your company's performance. Definitely this may take some more time. There is also possible that the index level remains at the same level and your portfolio steadily starts rising. When this will happen? This will happen if most of the companies in your portfolio start performing well. So the question arises, what to do at this juncture? So what I say, the success formula is very simple. Remain invested in about 15 undervalued top stories. Okay. So the first two words are remain invested. Remain invested means, as a principle, I never keep cash with me. I never sell and keep cash with me in the expectation that the market may decline further, because I truly believe that I cannot predict the index. I cannot predict the market. I am always prepared. So always remain 100% invested. In SVP, I don't remember that we have ever kept cash of more than 5% or 10% during last 1 years. Especially during last 12 years, I have not kept more than 0.5%. We are always fully invested in 15 number of stocks. Why 15? Why not 5? Because you can invest in also in 5 stocks. In fact, Warren Buffett has got billions and billions of dollars, and almost 75% of his total portfolio is invested in only 5 companies. He has got a very good knack of picking the right stocks, and he is very much confident. In fact, in many of the companies, he himself is the owner. He owns the majority stake. So he has got right inputs, and that is why he keeps his portfolio so much concentrated. As a retail investor, 15 to 18 stocks are sufficient. Statistically, it can be proved that 15 to 18 stocks can to mitigate the stock-specific risks. Then the word is undervalued. Yes, you can have very good companies in your portfolio. We all know the blue chips, but then they have got the good story. They are available in number, but there is no sense if they are all overvalued. So whatever stocks you are holding in your portfolio, they need to be undervalued, to be available at attractive valuations. And then the top stories. Stories means, what is the thing which will take their earnings per share to high levels, to fast growth in times to come? What is that story? Is there a change of product mix? Is there an acquisition? Is there a change of CEO? Like these, stories like this. Now we come to the expectations from the budget. Generally, I don't expect much from the budget, because government has got its own preferences on priorities, and also nowadays in between the budgets also lot many reforms are taken care. So budget is not that critical or important as it used to be about 20 years or 30 years back. But most of the things we all know, means there is a high probability from the budget that it can have some populist measures, considering that next year there is going to be elections. But don't expect much more great populist measures. My understanding goes that government will stick to the discipline, fiscal discipline. There can be some populist measures with regard to the income tax exemption, something like that. Continuing investment, yes, private investment is yet to catch up. So government will, in all probability, will continue to invest in infrastructure and further opening of defense and space sectors. This is a very, very important sector, and one should not overlook these segments. There are a couple of very good stocks, and one of those stocks we have recommended in our last Smart Report. Smart Report is a single report, but a part of Smart Multibagger. Those who are interested to subscribe to the latest Smart Report, which has been published on 18th of January, they can scan this code. The target returns are 4.1 times, and time frame is 4 years and 6 months. More details, if you want to know about this report, you can visit our website for smartvrc.com and Smart Report. Also, you can scan this code. So with this, we have come to the today's presentation, and the smart word which I keep on saying is share price eventually follows earnings. So always focus on the earnings. Earnings means the earnings per share is going to rise, what the company is doing so that the earnings per share will rise in future. Ultimately, share price has to follow the earnings. Yes. So don't worry about the market, where the market is heading for. Look for the earnings where they are heading for. Thank you. So such type of webinars, and also we keep sharing articles, very insightful articles, to our members who are in our WhatsApp groups, even if they are not subscribers, but yet if they want to get those inputs, those insights, they can send us a request on this WhatsApp number 9755920780. And they should not forget to send the name and city they belong to. And also, I request all of you to save this number in your contact list. Otherwise, you will not get the communication from other side, because we send the messages on broadcast channel, and under broadcast channel, only those people receive the messages of WhatsApp who have saved our number in their contact list or address book. So, thank you very much. Now we start our question and answer session. Either you can raise your hand or hand in the emoji, or you can write in the chat box also, you can write. Maninder Singh from Punjab. Every seminar of yours is an eye-opener with new insights into investment education. Thank you, Maninder ji. Rajesh J. Would it be wise to invest more in defense stocks before budget? I never advise to invest for short term. Always look for long term. If you strongly believe that defense sector is the sector to invest, yes, then you can definitely invest, but I always invest from the long term perspective. It should not happen that you invest just from the budget perspective, and if nothing comes out about the defense in the budget, then share price may fall and you lose. Yes, any other query? So there is a direct message to me. What is your opinion on Zomato? So as a principal, I 99% of the time I look for the companies which are in profits. Loss-making companies we rarely advise. What is the long-term prospect of Bajaj Finance? Yes, Bajaj Finance has a very good long-term prospect, but don't expect the kind of returns which have been realized in the past. Definitely, the company will continue to find the ways and to enlarge its portfolio. And already the subsidiary, which was subsidiary with the name of, I think, Bajaj Housing Finance, which was incorporated just 4-5 years ago, is doing exceptionally well. And it is contributing to about 10% of the profits of the consolidated Bajaj Finance results. And those profits are rising by 100% per annum. So company will find the ways and have a confidence on the management, have a confidence on the CEO of the company. Where we are headed from here on the market. As I said during the presentation, I am not bothered about the market because I am bothered about my company's CEO, my company's story, my company's earning per share, my company's product portfolio. That is what I am bothered for. But regarding the market, I don't have much control. I have a control about the stocks or the companies, what I select, but I don't have the control on the market. I subscribed to Smart Gains around September 22 and invested in SBP at that time. Now some of the stocks in SBP are falling. What to do? Should I average? So SBP is down by about 3 to 4%, I believe, from the peak of 144 or 145 lakhs. So nothing to worry about. And don't try to change the weightage of the stock until you have the confidence on yourself. Otherwise, follow as what we do. What number of stocks should a well-diversified portfolio have? For a retail investor, I would advise to have at least 15 stocks. Are you planning any seminar in Delhi in the near future? Presently, we don't have finalized any plans for Delhi. Can you please suggest the best PSU bank from mid and small cap category? Okay, once again, as a from our experience, we find that the private sector banks are doing much better in the long term. So we are more focused on the private sector, and also there are a lot of social obligations for the public sector. That is why, from the social welfare point of view, they are doing very good job. But as you know, all the priority of the private sector is the exploitation of the profitability. They are more connected with the profitability, and share market is also looking for the profitability. So we are solely focused on non-PSU. Can we also build a portfolio of smart multi-bagger recommendations? Yes, you can build, but you will appreciate that it is not a kind of a portfolio management service. So also we are not maintaining any kind of portfolio in case of smart multi-bagger. You will have to manage on your own. We only provide you the weightage allocation, but that alone is not sufficient to manage a portfolio, manage a well-diversified portfolio. I am a subscriber of Smart Multi-Bagger. How can I get the recommendations from SBP? SBP is complimentary only for the subscribers of. Okay. Any other query? Thank you, Deepak Agarwalji, for your message. Yes, definitely. I also want that more and more number of investors should subscribe to our services and get benefited, not only from in terms of the direct advice, but also from the perspective of learning. A lot of things to learn. When I was of your age, I was looking for a mentor. Unfortunately, I couldn't get any. But nowadays, even the internet is sufficient to act as a good mentor. Thank you. So with this, we have come to the end of presentation. Thank you very much. Have a good Sunday. Bye-bye.